For months, the US dollar has been, well, weirdly stable. Almost a little too quiet, you know? But that all just came to a screeching halt last week. Okay, so let's dive into this sudden, pretty dramatic fall and figure out what's really going on.
Right, so after all that calm, the dollar just cratered. And we're not talking about a little dip here. This was its steepest one-week decline since the whole period after Liberation Day. This wasn't a gentle slide, this was like falling off a cliff.
And that really brings us to the big mystery we're going to unravel today. After all that time just holding steady, why did the market suddenly panic? What on earth was the trigger?
But look, before we can solve this thing, we need to understand how we're even tracking the evidence. And for that, the key tool in our kit is something called the dollar index.
So what is it exactly? Well, to put it simply, the dollar index doesn't just pit the dollar against, say, the euro or the British pound one-on-one. Nope. It actually measures the dollar's value against a whole group of major world currencies, all bundled together.
And you know, this difference is absolutely crucial. Because think about it, if the dollar weakens against just the euro, that could totally just mean the euro is having a great day. But when the dollar falls against that entire basket of currencies all at once, well, that's a huge flashing sign that the dollar itself is the one in trouble.
And man, the dollar has been on a total roller coaster lately. It actually surged when Trump first took office, hitting a 2-year high back in January 2025. Then came that really steep drop after Liberation Day, which was followed by a pretty calm period last summer. And all that brings us to last week, when it all came crashing down again.
All right, so we've got the background. Now let's start the real investigation. We've basically got 3 main suspects, the immediate triggers that we think are behind last week's sudden sell-off.
We're going to look at each of these one by one. First, some geopolitical fears. Second, a very deliberate move by Japan's central bank. And third, the growing threat of another government shutdown happening right here at home.
So trigger number 1 was all about geopolitics. When President Trump made those overtures about Greenland, it immediately sparked fears of a brand new trade war. And even though he did back down eventually, the damage was already done. The whole move left markets feeling, and this is a quote, permanently spooked by what they saw as a disdain for the global rules. And that kind of unpredictability, well, that's what makes other countries start to question if they should rely on the dollar so much long term.
Okay, now for trigger number 2, and this one involves the Japanese yen. To really get its impact, you've got to look at its weight in the dollar index. The yen, all by itself, makes up about 15% of that basket. That's a big slice, which means any significant move in the yen is going to have a direct and really powerful effect on the whole index.
And that is exactly what happened. The Bank of Japan stepped in directly, spending its foreign reserves to buy up tons of yen and force its value higher. Now, because the index measures the dollar against the yen, a stronger yen just mathematically means a weaker dollar reading. Simple as that. At the same time, nervous investors were also flocking to the Swiss franc, which is another safe currency in that basket. And that just piled on, amplifying the downward pressure.
And trigger number 3, it's domestic. It's the renewed threat of a U.S. government shutdown. We've got a January 30th funding deadline just around the corner, and there are serious threats to block funding for Homeland Security. You know, shutdowns are always a mess, but a second potential shutdown in just over a year, that just sends a terrible message to the rest of the world that the political system behind their main currency is, well, dysfunctional. And that really shakes long-term confidence.
But here's the thing, those 3 triggers didn't just happen in a vacuum. They hit a dollar that was already weak, already vulnerable because of these deeper, long-term pressures that have been building up. In our investigation, let's think of these as the motive.
First up, there's the constant pressure on the Federal Reserve. President Trump has been very clear that he wants lower interest rates, and he seems willing to push the supposedly independent Fed to get them. For the markets, that's a huge red flag for future inflation. But it's more than that. It kind of chips away at the trust in an independent central bank, which is one of the absolute bedrock principles of the dollar's status as a reliable currency for the whole world.
Now, this second pressure has to do with the dollar's special job in the world. See, since World War II, it's been the world's main reserve currency. That just means it's the main currency that central banks all over the planet keep in their savings accounts, their reserves. And that creates this massive, constant demand for dollars.
But that special status, it looks like it might be starting to fade. According to the latest numbers from the International Monetary Fund, the dollar's share of global reserves has actually slumped to a 30-year low.
So here's the crucial takeaway from that. It's just basic economics, really. When global demand for dollars as a reserve asset goes down, the value of the dollar tends to go down right along with it. This is a powerful, long-term headwind that the dollar is facing.
So what's the verdict in our investigation? Well, when you put the immediate triggers and those background pressures together, you get a really clear picture of what just happened, and a much, much less certain one of what's coming next.
It was pretty much a perfect storm. You had these immediate shocks, the Greenland spook, the yen surge, the shutdown threat. They were the catalyst. But they landed a punch on a dollar that was already fragile because of these underlying anxieties. The fear of politics messing with inflation, and that slow grinding erosion of the dollar's role as the world's go-to currency. That combination is what turned a little dip into a giant crater.
And all of that leaves us with one final and pretty crucial question. We've explained the crash, but what does it all mean? Are these just temporary shocks to the system, or are we actually witnessing the first real crack start to appear in the very foundation of the US dollar's decades-long global dominance?